Is the Golden State's housing market teetering on the brink of a crisis? What role do insurance companies play in this unfolding drama? Let's set the stage with a snapshot of the current state of affairs in the California housing market. A recent article from Business Insider, dating back to August 23, 2023, paints a fairly concerning picture. Homeowners already dealing with the aftermath of climate-related disasters are facing an increasing challenge. Insurance companies refusing to renew policies in high-risk areas. It seems that the frequency and severity of these disasters, amplified by the climate crisis, have led insurers to rethink their strategies. California, known for its sun-kissed beaches and towering redwoods, is now being seen as a high-risk state. And it's not just about the wildfires. The state policies, including premium caps, are further complicating the situation, causing ripples in the insurance market. Now imagine being a homeowner in this scenario. You've survived a disaster, you're trying to rebuild, and then you find out that your insurance policy won't be renewed. Or worse, the premiums have skyrocketed to a point where they're just out of reach. And the fallout isn't limited to those who are directly affected by these catastrophic events. The economic impact of the climate crisis is becoming increasingly evident across the state, and it's a domino effect really. As more and more homeowners struggle to insure their properties, the number of uninsured homes is growing. Coverage for those who do manage to hold on to their insurance is being reduced. The economic fallout is clear, with a growing number of uninsured homes and reduced coverage for those who do have insurance. This, my friends, is a crisis in the making. But how did we get here? And more importantly, where do we go from here? Stay tuned as we delve deeper into this unfolding drama. This isn't a problem confined to California. Let's turn our attention to Florida, where this crisis first took root. In the Sunshine State, the insurance crisis has cast a shadow over homeowners. According to a Business Insider article from September 2023, insurance rates have surged due to a potent cocktail of inflation, rising flood risk, and the ever-looming threat of hurricanes. This has led to Florida being crowned with the dubious honor of having the highest average insurance premium in the United States. Just like California, Florida is grappling with the escalating risks of climate crisis-induced disasters. This has had a profound impact on homeowners who are now caught in precarious situation. On one hand, they face the tangible threat of natural disasters, which could potentially wipe out their homes and life savings. On the other hand, they are grappling with surging insurance premiums, which are becoming increasingly unaffordable. This isn't just about the financial burden on homeowners, it's about the potential destabilization of the housing market. As insurance rates rise, homeownership becomes less feasible and less attractive. This could potentially lead to a decrease in demand for houses, leading to a slump in the housing market. And we've seen what happens when housing markets crash. It's not a pretty sight. The situation in Florida mirrors the crisis unfolding in California. Both states are facing increased risks due to the climate crisis, leading to rising insurance premiums and a growing number of uninsured homes. Both states are witnessing the withdrawal of insurance companies from high-risk areas, leaving homeowners in a lurch. Both states are on the brink of a potential housing market crash, driven by the escalating insurance crisis. The escalating insurance costs are driving people away, threatening to destabilize the housing markets in these states. And as we've seen, this isn't just a problem for homeowners, it's a problem for the entire economy. After all, when the housing market crashes, it takes a lot of other sectors down with it. What does insuring a home in the face of this crisis look like? Brace yourselves, the figures might shock you. We turn our attention to a Business Insider article from October 5, 2023, which provides a stark illustration of the escalating costs of homeowners insurance. Oscar Sikely, CEO of NSI Insurance Group, paints a troubling picture of the market's trajectory. Over the past decade, insurance premiums have not merely increased, they've tripled. The financial burden homeowners are shouldering is becoming increasingly heavy, and the strain is starting to show. Imagine, if you will, a $5 million home. A decade ago, the annual insurance cost for such a property was within reach for many. But today, that same home could cost between $35,000 to $40,000 to insure annually. The driving force behind this surge? The escalating and unpredictable risks associated with climate-related disasters, particularly wildfires. These risks have insurers on high alert, concerned about potential losses. And it's not just the homeowners feeling the pinch. Reinsurance costs, that's insurance for insurers, have also spiked, leading to increased premiums for policyholders globally. But here's the crux of the matter. This situation as it stands is unsustainable. The financial burden is becoming too great to bear. High-end homeowners, those who once had the means to shoulder higher costs, are now feeling the brunt of these premium hikes. With premiums reaching sky-high levels, the sustainability of the market is in serious question. The warning bells are ringing loud and clear. The question remains, will they be heeded in time? The insurance crisis isn't an isolated issue, it's a domino that could topple the entire California housing market. This isn't a sensationalist claim, it's a stark prediction of what could happen if the current trend continues. The insurance crisis, which began in Florida and has now spread to California, is a ticking time bomb. As more and more insurance companies pull out of these high-risk areas, homeowners are left in a precarious position. Without insurance, they face the risk of losing everything in the event of a disaster. But with insurance premiums skyrocketing, many simply can't afford the necessary coverage. This, in turn, has a ripple effect on the housing market. Demand for homes in these areas could potentially fall as prospective buyers are deterred by the high cost and limited availability of insurance. Why invest in a home if you can't protect it? And as demand falls, so too could house prices. It's a basic principle of economics. When demand decreases and supply remains constant, prices tend to drop. A decline in house prices could lead to negative equity, where homeowners owe more on their mortgage than their home is worth. This could potentially lead to an increase in foreclosures, further destabilizing the housing market. But the impact doesn't stop there. The housing market is a key driver of the wider economy. It influences sectors such as construction, real estate, and retail. A decline in the housing market could lead to job losses and a decrease in consumer spending, potentially triggering a broader economic downturn. Furthermore, the insurance crisis could exacerbate existing social inequalities. Those with lower incomes are more likely to be uninsured or underinsured, leaving them particularly vulnerable to the impacts of climate-related disasters. This could lead to an increase in poverty and homelessness, putting further strain on social services. In short, the insurance crisis is not just a problem for homeowners, it's a problem for everyone. The fallout from this crisis could reverberate throughout the entire California economy, affecting everyone from homeowners to renters, from businesses to government agencies. As insurance becomes an unaffordable luxury for many, the very foundation of the California housing market is under threat. The consequences of inaction are clear. The question now is, what can be done to avert this impending crisis? With the crisis escalating, what does the future hold for California's housing market and its beleaguered homeowners? As we peer into the crystal ball of California's future, the outlook appears bleak. The escalation of climate-related disasters across the nation, coupled with insurers retreating from high-risk areas, paints a grim picture. But let's not forget, every crisis presents an opportunity for change, for reform. Experts like Oscar Secali, CEO of NSI Insurance Group, are sounding the alarm bells. The surge in insurance premiums, tripling in the past decade, is unsustainable. This isn't just a problem for high-end homeowners feeling the brunt of premium hikes. It's a burden that we all will eventually bear. However, this foreboding scenario doesn't have to be our destiny. The crisis can act as a catalyst for change. It's a chance to reassess state policies that are exacerbating the issue, like premium caps, and to explore innovative solutions to mitigate the crisis. What could these solutions look like? We could consider the implementation of risk-adjusted insurance premiums that accurately reflect the level of risk associated with a property, or the development of public-private partnerships to share the burden of risk. Perhaps even the creation of state-run insurance programs to ensure coverage remains accessible for homeowners in high-risk areas. But these reforms won't materialize overnight. It will take time, effort, and the collective will of policymakers, insurers, and homeowners alike. There's no denying it, these are challenging times for California's homeowners and the housing market. The escalating insurance crisis, fueled by the relentless march of the climate crisis, is a formidable adversary, but it's not insurmountable. The path ahead is uncertain, but one thing is clear: action is needed, and it's needed now. The future of the California housing market hangs in the balance.